Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. It's Bobby Rains here again for our once every 3 weeks investors only, members only workshop, or Investors Observer members only workshop. Yeah, let's get started. We're going to start off with a market update. I don't really have any updates about what's going on in Investors Observer this time around, so we will skip that bit, and then after I tell you what's going on in the market, the rest will be up to you. Questions, things about the website, whatever it is that you want to talk about, that is what I'm here for. As always, if you have a question that you'd like to ask and would like to see broken out in some detail with slides or something, I'm more than happy to do that. Just send me an email ahead of time and mention it's for the webinar. And I usually try to answer those, get you some answer by email and then provide a longer answer in the workshop as well, so you don't have to, just wait 3 weeks to get your questions answered. All right, let us go forward. All right, so this is 2 years of the S&P 500. I grabbed these 30, 45 minutes ago, so today's candle may not be exactly right, but the rest of it's pretty close. We were kind of between 2800 and 28.6 in terms of strong levels of support or resistance. And those go back a while. I could have drawn these lines out a little bit further. Obviously this guy comes right across here, and then this guy comes back pretty much to this old high. And then you can zoom in and see it a little bit closer on a 1 year chart. Which is what this is. It's not super shocking. I think it was Thursday last week we touched this high and then sold off on Friday, and then haven't done anything particularly auspicious this week. But it's not super surprising given the strength of this rally from the December lows. It's not super surprising that we haven't had we're taking a little bit of a rest here, so I'm not super worried about it from a technical level. Just to give you an idea of some internals, the NASDAQ 100 here, so that's the top 100 biggest companies by market cap on the NASDAQ. It's mostly Apple, and then exactly who to expect: Facebook, Amazon, Google are probably the next biggest. It's been super strong. It's actually gotten higher to the old highs than the S&P 500 did, but also a little bit weak this week, which is again not really super surprising given the strength of the rally here. All right, so let's look at some sectors. This is the bank ETF over the last year. It's sort of interesting. This big drop last week, you can probably attribute that to the Fed. What's interesting about it is, you have the yield curve inversion that people are all worried about, but banks aren't really as hurt by a yield curve inversion as people would think. Not all of their assets and liabilities expire in the exact relationship that you would expect. Banks can have long-term bonds, et cetera, that they pay interest on and then collect interest at, on shorter-term loans they give out. So, and net interest margin generally has become a much smaller part of bank revenues as they've moved toward a fee-based model. I mean, interest rates have been pretty flat for a long time now. And yet banks are still wildly profitable. So this is not so much that. So did the banks sell off last week because people don't know where banks make money? Possibly. Also possibly because, as we'll talk about when we get to my what else is going on slide, there's a certain amount of it seems like the Fed may have been a little over or maybe under optimistic, let's call it, in terms of their economic forecast. There's being patient and waiting on the data to try to tamp down inflation, and then there's being not optimistic enough about economic growth. And if banks are basically just making a commission for economic activity and you're expecting there to be less economic activity. That, to me, makes more sense here. I don't know that I agree with that forecast, but in any case, it's was a pretty big move in the banks last week. And then next we have home builders. You can see home builders didn't move quite as far, right, which is interesting. Home builders haven't been super strong. This is a very different chart than the banks or the S&P, but they are back, not super far from where they were in October, or at least, they hit highs a little bit earlier. And the thing about banks, the home builders, is home builders do better with lower interest rates, right? So if you think about someone buying a house, most people aren't buying a house based on the sticker price of the house. They buy the house based on how much monthly payment you can afford. And your monthly payment is divided between interest and principal. And when you start a mortgage, most of the loan is interest. And so if you're essentially payment sensitive and not actual price sensitive, then having a lower interest rate means you can afford more house. And so that should lead to more home sales and higher selling prices for home builders. So that's that. There has been a lot of noise recently about weak data in home building, but home sales data is always super noisy in the winter months. You get a snowstorm here and a flood there, and it's really hard to actually get out and build a house. So it's really hard to, it turns out, sell a house that you couldn't build because the weather was bad. So we should start seeing that sort of turn around and hopefully snap back to form in the next month or two. But the winter home sales data is always really noisy and frequently sort of worse than it looks. Right, healthcare. So healthcare is interesting because it actually, right, the rest of the market sort of rolled over in October and then steadily went down until that day after Christmas. But healthcare actually set a new high late in the year, which is interesting, and then started to come back again, and still is not far off of these highs. This was when there was a brief panic in the healthcare stocks about Medicare for All gaining traction, and we gained most of that back. Obviously, not all healthcare stocks gained all of it back, but a lot of them did. It's interesting to me. There was a new there's a health insurance merger announced today. Centene and WellCare plans are going to buy each other up. They're relatively smaller players, but it's still a hundreds of $billion merger. So that doesn't seem to me like somebody who's expecting to be out of business in 2020. But yeah, it's kind of interesting to see how different this chart is than some of the others. And yeah, it's again, not super surprising. Like we had a sharp drop here and then a big rally here, and it's not surprising to see just some profit taking based on the incredible jump that we saw there a couple weeks ago. And then retail. So this is kind of a fun one because people, economists and market pundits keep talking about the strength of the consumer. And this doesn't look like the consumer is super strong. But this ETF is pretty evenly weighted across a whole lot of names. The number one name is actually something called Carvana, which I think is it's an online car dealer. And then there's Ulta, which is a cosmetics retailer, and there's some other auto retailers and auto parts, and a lot of traditional retail in there. Amazon is the number 3 holding, but it doesn't have a much bigger weight than the number 8, 9, or 10 holding. And so this is really more about, I think, change in the retail sector than the health of the consumer, because if we go to consumer discretionary, so there's 2 broad categories of consumer spending. There's staples and there's discretionary. Staples is exactly what it sounds like, right? It's your staples. Campbell soup, bread, things like that. Things that people are going to buy. Procter & Gamble is a big consumer staple stock also. Right? Those are things that people have to buy, right? Like you're not going to stop doing laundry and stop eating no matter how bad the economy is. And consumer discretionary and consumer staples, the charts, I actually looked at a comparison chart. I didn't pull one for today, but I looked at it, and the charts look pretty much the same over this 1 year period. And if people were really worried about the economy weakening, the economy was actually weakening in a significant way. People stopped spending on discretionary way before they try to cut back and save money on staples. And so that's sort of interesting. And so consumer discretionary is, it turns out, 24% of it is Amazon, 10% is Home Depot, and then you've got McDonald's, Nike, and Starbucks. So it's pretty different from that retail ETF, and people are still spending money, is what this tells me. A lot of retail stocks have problems that are sort of endemic to retail. I think it's interesting, right, that the much higher weighting of Amazon here really helps this over the XRT. Well, I thought this was sort of an interesting thing to compare this to this in terms of, oh, well, are consumers spending money? This would tell you one thing, and this chart would tell you a very different thing. And a lot of that is because of, problems that are endemic to the retail sector that have more to do with how and where consumers are spending money than they do with if consumers are spending money. So that was my look at the sectors, and then what else is going on? We now have sort of two areas of concern in terms of trade. We got data, I think, this morning that the trade deficit with China narrowed in January. That data isn't usually on such a big lag, but the government shutdown slowed the release of it. And the trade deficit narrowed from December to January, but a lot of that was probably had to do with people trying to get stuff into the country in January ahead of the January 1st deadline for tariffs to go up that ended up getting pushed back. So that may or may not be a meaningful narrowing in the deficit. And the other, piece of China, of course, is where is the deal? I'm old enough to remember when the President Trump was talking about meeting President Xi of China at Mar-a-Lago in March, and now they're talking about maybe toward the end of May that could happen to finalize a deal. So I'm not, and there's also some reports out today that it's possible that a deal would look more like a truce than the sort of grand sweeping deal that we've been, it seemed like they were negotiating for a while. So I'm not really sure exactly what's going on there, but it is certainly a place of concern for anybody who's running a business that involves importing things, and also for investors. And then auto tariffs are also on the table. President Trump has said he wants to put tariffs on the auto sector, and there are some other people in the administration who've been trying to talk him out of it. Europe in particular would get whacked by auto tariffs because we do import a lot of cars from Europe. But the thing about auto tariffs is they're bad for everyone, right? Like the idea of an American car doesn't really exist anymore. An American car versus a European car versus a Japanese car is really more about where a company is headquartered than where it's made. For example, BMW is the leading exporter of automobiles from the United States. They export more automobiles from here than anywhere else. So, the idea of these are American cars and these are foreign cars has all kind of gone out the window, and it turns out that auto parts, the supply lines are worldwide. Things cross borders multiple times before they're finally finished. There is a global supply chain for automobiles, so it's very difficult to sort of say, oh, well, these are American cars and these are foreign cars. So it turns out that auto tariffs would probably have an effect on all cars in some way. It's just a question of the prices of which would go up more. And we haven't heard much talk about it lately. There's been plenty of other things to talk about. But the debt ceiling is potentially a thing that could roil the markets. That deadline is in early June, last I heard. We still have the quarter ends Friday. So we'll have another earnings season before that, which will probably be more interesting to talk about next time through. But that debt ceiling deadline is coming, and that has 2011. There was famously quite a quite a disruption in the market when that happened. And then, yeah, the Fed and interest rates. I think that, they're still sort of aggressively patient. But I think maybe so dovish, as I kind of alluded to earlier, as to spook the market. They said, we're not expecting a lot of economic growth, not raising rates again this year. And the yield curve inverted as investors sort of were like, whoa, the Fed doesn't expect inflation or growth, so we're going to go buy bonds for the safe return. And then if the front end of the curve doesn't rise and you buy up bonds further out and push that part down, the yield curve inverts. That's how that works. So that happened, and then, the yield curve inverting causes people to panic further, and it becomes sort of a self-reinforcing cycle. And then, Brexit. There was some stuff today where Prime Minister May said she would resign after she had delivered Brexit, but I'm not 100% what delivering Brexit means. Does that mean after Brexit happens? I mean, after they vote on something? It seems like Britain could be out of the EU as soon as April 12th. And also maybe never. And I'm not really sure when we're going to find out when that's going to happen or what is going to happen. So, that's that. And that is, that brings me to the end of my prepared remarks. So the rest of the time we have today is for questions. Happy to talk about any of these things. Also, anything you have questions about on the website or etc. If you have a question, just type it into the little question box there in the GoToWebinar thing. There we go. All right, so we have a question from Bill about essentially why is Europe down so much over the past year, and do I think it will come back? There's a bunch of things going on there, Bill. I mean, the first is, I'm assuming you're looking at Europe stuff denominated in dollars. The dollar has been super strong, which kind of makes Europe stuff look cheap. And then also there are things like Brexit. You got the yellow vests in France. Italy seems to be a series of crises, whatever the plural of crisis is. And then, Greece's economy still isn't very healthy. There's a lot of things going there. Britain obviously is a huge economy that may just drop out of the sort of consolidated trading area there, which would mean, certainly a no-deal Brexit would be bad for the Brits, but also it's not great for economically for people in Europe. I don't think the Europeans need to worry about like stockpiling food and medicine like people have warned the Brits to do. But it's certainly not good for their economy. So I mean, it certainly could come back. I think you need some more. You need less uncertainty before people really feel comfortable putting a lot of money there, though. Just because, nobody wants to invest in a thing where the outcome is very, very uncertain. So that's why it's down. And then also, the dollar keeps strengthening, and that's short the dollar has not been a great trade, but it seems unlikely to keep going up forever. I think there are some structural reasons that it'll probably soften up a little bit eventually. But I certainly don't know when it will come back. I don't think it's going to keep going down forever. But when it's going to come back, I certainly don't know. All right, so Victor has a question. He says, what is meant by diagonal versus vertical options? So let's go, let's see here. There we go. Yeah, so in our portfolios and also in the trade idea generator, we have, different kinds of option strategies. So a diagonal, well, actually, let's start with vertical. So a vertical spread is typically one that has options that expire at the same date. And so if you have different strike prices and same date, those are, if you think about an option chain, essentially a vertical line between the two. You got two options expire at the same time, and then the strike prices are different, so it goes up and down between the two. There is another kind of strategy that we don't actually employ here at Investors Observer, commonly called a calendar spread, but also sometimes called a horizontal spread, and that would be the same strike price at different dates. And so if you think about, things going out in time as being horizontal and strike prices being vertical, that leads you to the conclusion that something with different strike prices and different expiration dates would be diagonal, because you go up and down and inside of there. And now you can there are debit spreads that are vertical, and I certainly think I could construct I'd have to really think about why I would want to do it and what it would mean, but I could construct a credit spread that was also diagonal. But the big difference in terms of what we do here is the diagonal spreads are debit spreads also, whereas most of our credit spreads or most of our vertical spreads are also credit spreads. And the difference there is in a credit spread, you actually enter a trade for a net credit as opposed to buying a position and then selling it later. So a credit spread is like being short options, essentially, right? You're a net seller at the open, and the goal is, like with any short trade, that the underlying, in this case, the price of the options goes to zero during the course of the trade, and then you just keep the money you got for selling it, and the options go away. With a debit spread, obviously you're a net buyer of options, and so you're hoping that you can sell those options or close that position in any case for more than you paid to open the trade. At Investors Observer, we don't currently have any just long call or just long put trades. We have discussed adding them in the future, and we probably will get to that at some point, but I don't have a timetable for it. At the moment, the spreads are they're a little bit easier to predict and a little bit easier to sort of recommend, in the sense that we, most of these we don't actually need the stock to move in order to be successful. Most of them we just need the stock to stay roughly where it is when it opens, or move in one direction or the other. So that's a trade that's more easy to win. Jeff has a question about MCK. Jeff, it's a good question. We've been watching this one. You'll see here. Let me get a year just so we're at consistent time frames. You can see the shape of this 1 year chart is pretty different than the shape of that healthcare chart I had up earlier. There hasn't been a lot of news on the stock. It's been soft. Some other drug retailer, drug companies have been soft also. But McKesson is in the healthcare sector, but it just hasn't it really hasn't bounced back the way we would have hoped. At this point, we're just sort of hoping to manage it and look for an exit. It is in the drug distribution business. I don't know. One thing that has occurred to me, but I haven't seen documented anywhere, is they could be tied up in a one of these opioid crisis lawsuits. I haven't seen that anywhere. I certainly haven't seen them settle. I know Purdue Pharma settled with Oklahoma earlier this week, but I haven't seen that from McKesson. But McKesson is generally a drug distributor, sort of buying drugs from the drug makers and then selling them to PBMs and drugstores and things like that. So, yeah, the short answer is I don't really know. It's disappointing, but we're trying to keep an eye on it, and at this point, largely sort of looking for a graceful exit. Although it could bounce back, but yeah, we're not super optimistic as far as that's concerned. All right, let's see here. We have a question about AXSM. It's not one that I'm quite as familiar with. Yeah, it's that's an interesting chart. It seems like there's probably news a couple of these times, or maybe it's other days. Let's see here. Yeah, I know Biogen canceled an Alzheimer's trial earlier this month, which seems like something that AXSM is also in the business of. So a potential competitor disappearing is obviously possibly a positive, although yeah, preclinical therapeutics is usually pretty early stage, so it's kind of hard to know. Preclinical therapeutics and no earnings kind of suggest they don't really have any drugs at market right now. So really, it's these kinds of things where we tend to stay away from these in the in the trades that we make here, largely because they're entirely headline driven. A good trial result and it'll go zooming up. A bad result for a competitor and it'll also go zooming up. Generally that chart doesn't look bad. It's still making sort of, this is a lower high here, it looks like, which isn't great, but the lows here are also higher and it's pretty much on trend. So from a technical perspective, I wouldn't be super worried about it. I can't tell you when it's going to make a new high, but it's hard to, it's really hard to say much beyond that because at some point it is going to come down to fundamentals, and this is a company that's basically doing science experiments and hoping one of them hits. So it's hard to know much about the long-term prospects of the company. All right, so Eric has a question. He says he just signed up for the trade idea generator service and he's still learning to use it. He found he's inundated with all kinds of information, and do most people use all the information? I mean, the short answer is no, Eric. Outside of, I think, people who probably sign up for one or two of the portfolios, I don't think anybody uses all of the information in any of our services. The Investors Keyhole, for example, there's 4 trades a day, and if you figure there's usually about 20 trading days in the month, that's something like 80 trades a month. I don't think anybody has the time or inclination to make 80 vertical spreads trades a month. And certainly the trade idea generator we put out, it's north of 2,000 covered calls and short put trades every day, and then hundreds on the other side. So nobody's doing all that. The idea is outside of the portfolio services, that you can find some trades that you like and sort of pick and choose and go from there. The trade idea generator, let's go over there, does have the screener, obviously, and then we do have our featured trades, and then trades picked for you. There's the you can pick strategy and then pick a risk tolerance. And if those trades aren't to your liking, you're more than welcome to screen, and you can sort by all manner of categories. But we don't really expect anybody to use all of the service, just because most of them are pretty expansive. The idea generally is we're more of a research service. We're sort of here when you need us. If you want to trade, we've got one. Things like that. And I don't think there is an optimum use of a service as it's expanding. Like if we had a very narrow use case, we probably wouldn't offer such an expansive service. But we have people who do all kinds of different things. People call, and they have questions or call for various reasons, and I talk to them, and I'm frequently surprised by the things that people are doing, because it's not a thing that I would have thought of or something like that. So we have all kinds of users. It turns out that's what makes markets work, right? If everybody in the market wants to do the same thing, then the market freezes because everybody's buying at the same time and nobody's selling, or the opposite happens. So there's no real right or wrong way as we imagine it to use the service. We try to make sure that every trade we put in is is a good one. Obviously, that doesn't mean they're all going to win, but we try to have good information and good thinking and good logic underlying the systems that we use here. All right, so Thomas asks, why do we buy and sell puts in the bullish vertical spreads? Would buying and selling calls have been better? It turns out that it's largely the same, Thomas. Buying and selling puts, it turns out, is makes it a credit spread. Let me pull up an option chain here. Since you asked about CRM, we'll just pull that up. I don't remember what the expiration date on that guy is. I think it might be next Friday. Let's look. Yeah, 4/5. All right. So if we look at the option chain here, you can sell a call or sell a put right at 52.50 and buy one at, say, 152.50 and buy one at, say, 150 for at least 64 cents, right? So if you sell it at the bid, you get 164, and then you pay out $1.20, you get a net of 44 cents there. And you could probably get more because the bid-ask spread here, but for argument's sake, let's go with that. So that's 44 cents. Or you could buy one for $6.40 and sell one for $4.30. That actually looks a little bit better in terms of the P&L in this case. Just because of the way the math works out there, you get what is that, $1.05? So that might work out a little bit better. That ends up being a debit spread though. So in this case, you're buying options and hoping to close this trade for the $2.50 spread. In this case, you're selling options and hoping to walk away with the full credit as the options expire worthless. A lot of times that math works out pretty much the same. It really has to do with where the market is. There's a lot more volume on the put side here, which may have pushed the prices around, if I had to guess about why those two trades are so different today. But yeah, so I mean, the reasons to do a credit spread instead of a vertical spread are a credit spread instead of a debit spread, or some of it comes down to style. A lot of people prefer credit spreads over debit spreads. One of the things that happens is in a credit spread, if everything works out well, you only pay commissions to open the trade. Options expiring worthless, there's no commissions. Whereas this debit spread trade here with the calls, you're going to either have to buy and sell them to close, or go through exercise and assignment, which sometimes has even higher fees. So anytime you can save on fees, you're increasing your returns. And then you also run into issues with debit spreads. CRM doesn't pay a dividend, so it wouldn't be an issue here. But in the money calls are potentially at risk for assignment ahead of an ex-dividend date. So that just is one more thing you have to consider when picking trades, is to try to trade around the ex-dividend dates or do something else like that. And so it's just easier to do the puts. But really, it's largely an issue of style. And it turns out that I think, if I had to guess, certainly more people call and ask about the credit spreads than they do the debit spreads. But they are functionally the same trade, although the price is very different on that particular example we looked at today. All right, so I think our next workshop is going to be, 3 weeks from today is 3/10/17. Should be about the 17th of April. So I will look forward to talking to all of you then. If there are no more questions, we can go ahead and shut things down. Who knows? Brexit may or may not have happened by the time we have the next workshop. We'll have to see. That will be certainly interesting, if not exciting. All right, so on the CRM, yes, in this particular position, right. So if your question is, should we have made a bearish trade instead of a bullish trade on CRM? It turns out that as of now, a bearish trade would have worked a little bit better because the stock is down. That's sort of a different question than the one I was answering earlier. I'm sorry, I may have misunderstood what you were asking, but that is correct. There was a lawsuit about Salesforce today, but it didn't seem. There was a headline about a lawsuit and sex trafficking. I don't think. Personally, and some other things I read made it seem like it's probably not that serious of a threat. We've got another week and a half before the trade closes, so we'll see how it turns out. I'm optimistic that it'll come back. I don't think Salesforce is going anywhere anytime soon. But yeah, that is correct that we are down $1.82 as of today, because it's below that 157.50 bought put. Sorry. All right, so yeah, we'll post the slides and video probably early tomorrow, as usual, and send out an email to let you know when it's up. We'll also start sending out invitations ahead of that workshop next month on the 17th. And then also, if you have any questions, you can always hit the help button on the website. Give us a call. But if it is something that you'd like me to break out and do some slides, I'm more than happy to do that. Just let me know. Say, hey, put this on slides for the workshop, and I'll be happy to do that. All right, so with that, I'm going to go ahead and sign off. Everybody enjoy the rest of your day.